Good afternoon, and thank you for joining us for today's webinar, PPP Loan Forgiveness, Regulatory Considerations, and the Application Process, presented by Eversheds Sutherland. I'm Christine Birmingham, Education Manager with FSI. With me today are Cliff Kirsch and Lance Phillips, partners at Eversheds Sutherland, along with counsel Issa Hanna and associate Bria Adams, also with Eversheds Sutherland. We are grateful to have this dynamic team with us to go over the loan forgiveness process with each of you today. If you have any questions for our panelists, please submit them using the Q&A icon at the bottom of your screen to be answered following the presentation. And with that, I will turn it over to Cliff to get us started.
Thanks, Christine. Thanks to FSI for having us. And a timely topic, PPP loan forgiveness. And I think a lot of the folks who are joining are coming from the perspective of wanting to hear practical considerations about loan forgiveness and the mechanics of that, and we'll cover that. But I think also some others might be coming from the perspective of trying to get current and up to date at the SEC end of things. So we're really going to cover both the SEC and sort of their focus, as well as the SBA and its focus with respect to the mechanics of loan forgiveness. And it's important to sort of come at this with both perspectives in mind, because both the SEC and the SBA are looking at different things, and they're both staying in their lanes with respect to what they're looking at. So the way we're going to sort of structure this is looking first, just spending a couple of minutes first laying out the contours of the PPP program. Just make sure everyone has the guideposts up to date. Then we're going to talk about the SEC's focus, mostly an exam focus, and we'll talk about that, and then we'll turn to loan forgiveness. Very, very pleased to be joined by my colleague Lance Phillips, who's a partner in our Chicago office, Issa Hanna, who's counsel in our New York office, and Bria Adams, an associate in our DC office. And with that, I think, Bria, I'm turning it over to you first to go over the contours of the program and lay out the program, and from your remarks, we'll then go to the SEC, and then we'll end talking about the mechanics of loan forgiveness. So thanks.
Thanks, Cliff. So just to give some background before we get to this first slide, on March 27th, which seems like it was years ago now, President Trump signed into law the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act. The CARES Act was designed to provide emergency financial relief for individuals and also businesses and specific industries in connection with COVID-19. The act had a very broad reach, but it included an array of stimulus measures, including loans for small businesses. So the Paycheck Protection Program fell under that umbrella of relief for small businesses. It initially provided $349 billion worth of aid. It was increased from there over time to approximately, I believe, $600 billion, maybe was the last count of total funding at its close earlier this month. There were a lot of questions initially about the eligibility of broker-dealers and investment advisors, given that some industries are traditionally excluded from being able to apply for small business loans. For the most part, broker-dealers and advisors were eligible, but it appears that advisors, for the most part, took advantage of this program more so than broker-dealers. So for purposes of this presentation, we're focused on advisors who have applied for the Paycheck Protection Program and received loan proceeds based on their applications. So on this first slide, we just wanted to go over kind of the basic eligibility requirements. Any small business concern as defined under the Small Business Act, or any other business that employs 500 employees or less. And then there are also specific industry standards. If you fall under a specific industry, there may be eligibility requirements with respect to size that you can go by, and so the SBA includes hints on that. Sole proprietors, independent contractors, and self-employed individuals are all eligible to apply on their own. And then with respect to the program, there is also a certification part of the application. So you had to certify in good faith that the loan was necessary due to uncertain times. You also had to certify in good faith that the proceeds of the loan would be used for allowable expenses, which I'll discuss a little bit about allowable expenses. And then the recipient of the loan would need to still not receive a loan for similar purposes and duplicative amounts from the loan period from February 15th to December 31st of this year. So in response to questions about certification, just to kind of go over some things that we saw within a few months, there was a lot of guidance issued by the Treasury Department with respect to a safe harbor. Sorry, if you can go back to the last slide. Just a few more points on certification, but there's guidance from the Treasury Department issued. They issued a safe harbor, which allowed the SBA's review of the Paycheck Protection Program loans with respect to certification. The Treasury Department stated that any borrower that, together with its affiliates, received less than $2 million in loan proceeds would be deemed to have their required certification concerning the necessity of the loan in good faith. And so they would not necessarily go back and question that. Any loans in excess of $2 million, however, would be subject to SBA review. And if the SBA determined that the borrower did not have adequate basis for the required certification, then they would ask them to repay the loan balance. And then the borrower would be able to repay the loan after receiving notification from the SBA, and the SBA said that it would not pursue administrative or enforcement actions against the borrower. And I think that that goes to kind of what the SBA and the Treasury would do, but it doesn't speak to what other regulators might do. So I think Isa's going to speak to that later. We could go to the next slide. So just more about allowable expenses under the Small Business Act. So the Small Business Act outlines what expenses you can use SBA loans for. In addition to that, the Paycheck Protection Program loan can be used for payroll costs, which I think Lance will probably speak to later about the percentage that you can use or that you must use towards payroll costs in order for a loan to be forgiven. Costs related to the continuation of group healthcare benefits, things like employee salaries, commissions, other similar payments, payments of interest on the mortgage obligation, rent, utilities, and interest on any other debt obligations that were incurred before the covered period. And then the most important aspect of this loan program is that these loans may be forgiven, partially or fully forgiven. A borrower that's seeking loan forgiveness documents, so Lance will talk about that later. And I will hand it over to Isa to discuss the ACC's guidance with respect to the Paycheck Protection Program.
Sure, thanks, Bria. And just to emphasize, thanks for having us today, and welcome to all the participants today. We're happy to be speaking with you. So moving into the SEC's investment advisor disclosure issues, as Bria said earlier, given just the nature of the types of financial services companies that decided to participate in the PPP loan program, we thought we would really drill down on the implications for investment advisors today. And a key piece of that for any investment advisor is how it's making disclosure to its clients regarding its practices around PPP loans, if it went out and got those. So why don't we go ahead and move into the next slide, Ali? Great. So the SEC staff, in a somewhat surprising and unforeseen kind of move, came out with FAQ guidance for the industry back in April of this year, when the PPP program was really in full gear, and shortly after the CARES Act had come into place and was signed by President Trump. The FAQ guidance had a few elements to it, and generally speaking, the message that the staff wanted to send to the investment advisory industry was that if you're an advisor that's gone out and gotten one of these PPP loans or some other type of financial assistance, like a new line of credit from your banker, you as an investment advisor still have an obligation to disclose material facts relating to that loan if it has some kind of impact on your relationship with your clients. And that's a very kind of broad statement that the staff made. But then the SEC staff followed that up with a couple of examples to illustrate when this disclosure is required. And again, these are examples for illustrative purposes only. There could be other circumstances, I think, in the SEC staff's view, where they would say, you know, a disclosure is generally required, you know, notwithstanding these specific examples. But the two examples that they gave were if an advisor requires the PPP loan assistance, for example, to pay the salaries of employees who are actually primarily responsible for performing advisory functions for clients. They have some kind of portfolio management responsibility for advisory clients. And, you know, their salaries were actually supported by the PPP loans that were obtained. In the SEC staff's view, that's information, that's material information that clients would want to hear about. Another example that the staff gave was that, you know, if there's a circumstance where the advisor is experiencing conditions that are reasonably likely to impair its ability to meet contractual commitments to clients, in that circumstance, the staff said you would have an obligation to disclose the existence of that PPP loan and you know, the amounts and the effects of it to clients. Again, you know, these are not necessarily exhaustive examples, and you know, just a general point here, given the uniqueness of the moment, the fact that the SEC staff went out of its way to provide this FAQ guidance to the advisory industry. Our sense is that the advisor community generally opted in favor of making disclosure of any PPP loans that they obtained. You know, in our estimation, just kind of looking at what happened after this guidance came out, it seems like advisors generally erred on the side of caution and decided to disclose. And you know, they generally followed the chapter and verse that the staff required firms to go through in terms of the elements of that disclosure. They generally describe the nature of the PPP program, you know, speaking to a lot of the concepts that Bria spoke to just a bit ago in terms of the background behind it and you know, the process for obtaining it, and you know, also noted the loan forgiveness aspect of it. They also generally describe the amount of the assistance as required by the staff. We did, however, see some firms in their disclosures, rather than sticking to just the flat amount that they received, also or instead getting into some kind of discussion regarding the length of time that the amount that they received would cover employee salaries. That's, you know, not necessarily you know, a bad fact to provide, and can see how that could work, and would also provide advisory clients with more meaningful disclosure, more understandable disclosure of the meaning of the assistance. And then, you know, they would also get into the effects of the assistance, generally how, for example, you know, it was able to allow them to continue meeting whatever commitments to clients that they maybe would not have been able to meet had they not gotten the assistance. So moving into the next slide, just some practical considerations regarding those disclosure issues. You know, I mentioned up top that a lot of firms had already, you know, gone forward and made disclosure. Something to think about though, did that disclosure necessarily align with other materials that you've continued to provide to clients? Is there perfect consistency between, you know, the Form ADV disclosures around your PPP loans and your marketing pieces and other communications in a written form that have been provided to clients? Something to consider if you haven't already. Another practical consideration for an advisor, did you go about delivering to your advisory clients some kind of interim disclosure with respect to the changes that you had made to your Form ADV? And in that regard, I would point the audience to an instruction in the Form ADV Part 2A, which generally says, you know, notwithstanding the general rule that, you know, in between your annual updating amendments, you're generally, you know, only required to make disclosure of certain disciplinary events. there is a note in the Form DV2A instructions that says you have an ongoing duty as an advisor pursuant to your fiduciary duty to inform clients of any material information that could affect the advisory relationship. So as a result of that, between an annual updating amendments, you might have to disclose material changes to that information to clients, even if those changes don't necessarily trigger delivery of an interim amendment. So that's something else to think about, given the sensitivity of the situation, whether you should go about making some kind of interim disclosure. And final point here as a practical consideration, you're going to want to make sure that any disclosure that you developed in response to your PPP loans is current, especially if your circumstances change. So maybe any pandemic-related financial difficulties have outlasted your PPP loan funds. If that's the case, you might want to look back to your disclosures and further describe. Maybe your loan forgiveness is not necessarily forthcoming or attainable, even though your disclosures said that you would be seeking it, and you would anticipate that, given the forgiveness, that would ease any kind of financial burden here. If it's not necessarily, coming through for you on the loan forgiveness side, you're going to want to revisit that disclosure that you made. And then last point here, if on top of any PPP loan that you obtained some other type of financial assistance, you're going to want to revisit your disclosures to make sure that that's disclosed as well, especially given that the staff guidance that I spoke about on the last slide was not necessarily limited to PPP loans. There's a specific call out there for other types of financial assistance. So that's an important issue to keep in mind as well. Moving into exam focus, if we could just go to the next slide. And why don't we fast forward through this one too? Dive right into the content. That's it. Yep, thank you. So going into exam focus, really to date, the SEC's exam focus has mostly been on publicly traded companies and the content of their securities offering disclosures. So if you're a publicly traded company and you went about and got one of these PPP loans, to date, SEC examiners have been looking at those disclosures that you make in connection with your securities offering filings and the certifications that you made to get the PPP loans to make sure they're aligned and that investors are receiving materially accurate information. With that said, with respect to investment advisors, we wouldn't necessarily say that the SEC's examination focus to date means that they're necessarily out of the woods. We think there's still some chance that advisors are going to be asked about any PPP loans that they obtained and the disclosures they made to their clients. There could be a number of possible areas that the SEC, in our view, could focus on. They could focus, for example, on how the loan proceeds were used, and specifically whether they were used in a way that was consistent with the disclosures that were made, and ultimately were those loans used to ultimately serve the best interest of clients, if that's just generally what they were obtained for. On the next bullet here, they might ask whether, or they might ask about the time period during which they were used, and specifically they might ask whether they lasted as long as the disclosures in your ADV said they were projected to last. For any advisors who applied but didn't receive any funds, we think it would be fair game if examiners asked about the advisor certification that it made in connection with that unaccepted or unfulfilled application, and how it maintained its operations and met its commitments to clients without those funds. And especially if an advisor who didn't receive those funds, notwithstanding an application, if such an advisor didn't make any kind of disclosure to clients about the condition that led to the application in the first place, we think it's possible that the staff could ask why no disclosure was made. And final point here, under possible areas of focus from an examination perspective, we think the staff could potentially ask whether the disclosures are adequately addressing all material facts relating to the advisor relationships with clients. And of course, that would be a very fact-intensive, fact-specific kind of scenario depending on each advisor's particular circumstances. But, I think the staff would be looking for some level of specificity about the advisor's circumstances that are tailored to the particular impact on its relationship with clients. Final point here on this slide, I think it's worth noting, and this is kind of harking back to a point that Bria made earlier. There was a pronouncement or some guidance that the SBA put out basically saying that if an advisor, or sorry, not just an advisor, but any kind of applicant, applied for and received a loan for an amount below $2 million, that the SBA, as an enforcement matter, from an enforcement perspective, would take the position that those loans would be deemed to be made in good faith, and that the certifications that such an entity made about the need for such loan are good enough for them, and they wouldn't take any kind of further enforcement action regardless of the circumstances leading up to the need or the application for that loan. That's all well and good from the SBA's perspective, but any kind of guidance from the SBA should not necessarily lead anyone to the conclusion that the SEC or other regulators are necessarily precluded from making enforcement referrals of their own based on their own determinations with respect to the certifications made. So despite, or in response to this risk, I suppose, we've seen a number of advisors who have been a little jittery about the risk of this. We've seen them mitigate that risk by drafting some kind of contemporaneous memo to file, explaining their particular business need, why they view the loan as applied for in good faith, and we don't think that's necessarily a bad idea, that you have that in your back pocket if an examiner from the SEC or any other agency comes in and starts poking around at this and starts throwing words around like False Claims Act or anything like that. So that's my spiel. I think Lance was going to take over from this point and get into the mechanics of loan forgiveness.
Thanks, Issa. Thanks, everybody else. Thanks, FSI, like Cliff and Issa said, and Bria for having us on and giving us the opportunity to talk to everybody today. I'm going to talk a little bit about, like Issa said, the mechanics around applying for forgiveness. Now, with the 20 or so minutes we have here, by necessity, this is going to have to stay at a relatively high level. There are very complicated and detailed rules that we just don't have time to dig into today. And on top of that, the rules has been well publicized, and everybody is probably aware that the rules have been changing on a weekly, almost daily basis. So we're going to tackle at a high level how this all works. What are some things that you should be thinking about? What are some of the kind of the repeat questions that we've seen as we've been working with clients to work through this? And of course, to the extent there are questions that go into more detail than we're going to cover today, of course, we would be happy to assist anybody with that. Allie, can we go to the next slide? So as Bria touched on, right, you're given these funds, even in the application for a PPP loan, you're given these funds for a particular purpose. The main driver of that is, the forgiveness process. What is going to be forgiven? The categories that Bria went through are exactly right. As a general rule, you are going to be forgiven to the extent the funds were used for the various categories that are listed here. Payroll costs, there's a rule that at least 60% of the forgiven amount needs to be used for payroll costs. That changed from originally what was 80%. It was originally nothing, then it was 80, now it's 60. The continuation of healthcare benefits, insurance premiums, employee salaries and commissions, mortgage interest, rent, and utility payments. Now, as I mentioned, there's a bunch of nuance packed into each one of these categories. You know, this bullet we have, this sub bullet we have here, we see relatively regularly to the extent an employee makes over $100,000 a year. The prorated portion in excess of $100,000 a year is not something that will be forgiven. Some other nuances that have come up relatively recently, if you're paying rent to a related party, say a shareholder of the borrower is also the landlord or owns the landlord to which the borrower is paying rent, there are limitations on the forgiveness amount there. Other limitations on if you sublease a portion of your space that you pay rent on, you need to deduct the amount of rent that you receive as a sub landlord from the amount that you're claiming forgiveness on. So again, it's just important to keep in mind that these are kind of the broad categories, and then within these, there are various limitations and nuances that have to be heeded. The relevant time period, originally it was 8 weeks from the date that you received the funds. That was changed to 24 weeks without the ability to go past the end of the year, December 31st. People who received their PPP loan prior to June 5 still have the option of selecting the 8-week period. Any number of reasons why that might make sense. If you've spent all your funds within that time period, it probably makes sense to use that as your covered period, just so you're no longer underneath the limitations on reducing headcount and employment that we'll talk about in a little bit. So for people who did receive the loan before June 5, particularly if you've used all your funds within the original 8-week period, that might make sense to do. There is an alternative covered period for borrowers with a biweekly or more frequent payroll, and that starts following the first kind of pay period following your loan disbursement date, whereas the other covered periods start with the loan disbursement date. So to the extent that's beneficial to you, keep that in mind. Ellie, go to the next one. Okay, so that's kind of your baseline forgiveness amount. Then you start with that amount, how much of the funds have been used for a proper purpose over the cover period. Then you need to reduce that back based on two main things. It's maintaining compensation for your employees and maintaining headcount. Again, the main driver behind the CARES Act and the PPP was to make sure that that employees were keeping people around and not terminating people to the extent they could. So with the comp reduction, you actually have 25% of a kind of a grace area. You can reduce comp and wages up to 25% over the covered period. Of course, as with any, the basis for comparison is important here. For the comp reductions, you look at how much somebody was paid over the covered period, okay, and then you need to compare that to Q1 2020, so Jan 1 2020 through the end of March, and the basis for reducing your forgiveness amount because of comp reductions is the difference between the amount that you've been paying people, on an average basis over your covered period as compared to Q1 2020. So with headcount, it's a little bit different. This one, there's no grace period. You look at what what the SBA has dubbed FTEs, which is full-time equivalent employees. And the calculation for determining FTEs, basically anybody who works 40 hours or more a week gets a 1, okay? If you're part-time, if you work 20 hours a week, you'll get a 0.5. Okay, so every employee, part-time, you have to factor in full-time employees, you have to factor in part-time employees. It's just a function of what kind of decimal they're given between 0 and 1. And then that's how you calculate your FTEs. So the thing that the SBA is trying to address here is, you terminate a bunch of your part-time people, but keep your full-time people, you're still gonna be penalized a little bit for that. So you look at the average of your FTEs over the course of the covered period, then you compare that to one of two dates. It's February 15 of 19 through June 30 of 19, or at your election, it's Jan 1 of 2020 through the end of February 2020. And then, like I said, there's no grace period with this, so it's really a fraction. What has been your FTE employment over the course of the covered period? You divide that by your FTE employment over these reference points. You multiply that fraction by your loan amount, and it's reduced accordingly. As with everything, there's some nuance to this one. There was some relatively helpful SBA guidance that said if people are just resigning, if you've offered to hire somebody back after terminating them, or you've had to terminate somebody for cause, those things can be taken out of the denominator essentially and not factored into to the fraction that you need to apply to your forgiveness amount to reduce it. So basically those things are okay. It's important to note here, and not just for these items, for the resignations and other personnel issues, but really for everything with the PPP, documentation is key. This isn't just a conceptual point. The SBA has actually said that you need to maintain documentation essentially around everything that goes into calculating these amounts. It gets a little tricky in the case of a resignation, particularly if it's oral, or some of these other things that will not reduce your forgiveness amount. I mean, really, you just have to do the best you can. If you can get a written resignation, hold on to it. If you're going to offer to give somebody their job back, do it in writing. Do as much of this as you can in writing, just so you'll have something to bolster your application. To the extent it's not possible to get something in writing, which sometimes the way things go, that could be the case. Just do a memo to file. Just document, X person resigned on this date by calling X manager. Just do the best you can and try to just take notes of everything that happens real time. So those are kind of the general rules around the reduction in the forgiveness amount for comp reductions and headcount reductions. There is a safe harbor, which basically says that if you have reduced comp or headcount over a period within your covered period, you will not be penalized, even though based on the formulas we've just talked about, that would theoretically bring down your average. The safe harbor says you will not be penalized for those things if you restore comp or headcount to kind of pre-COVID levels before a certain date, which is generally the end of the cover period. There's some nuance to that, but it's generally essentially by the time your covered period is over. That is the safe harbor. Allie, next slide. Okay, so that's generally the formula. That'll, at a high level, like I said, that'll tell you how much of your PPP loan will be forgiven. I'm gonna move a little bit into the process, which we're getting a lot of questions around just as a firm. When can a borrower start to apply? So borrowers who are using an 8-week covered period, I think in all cases your covered period is done. So those people are particularly interested in applying. Also, people who are using a 24-week covered period might be interested in applying. I mean, if you're using a 24-week covered period and you spend all your funds in 10 weeks, 12 weeks, why would you want to wait? The SBA has said that you can apply early. So anybody, whether you're using 8 weeks, 24 weeks, it doesn't matter. You can apply, theoretically, you can apply now. However, there's going to be some special rules to determine the amount of forgiveness reduction. In particular, you will not have the opportunity to avail yourself of the safe harbors. You're not going to, of course, if you're using a 24-week covered period, you're not going to see the end of that covered period. And so if there has been a reduction in comp, you will not have the opportunity to restore that, because essentially your application will cut off on the date of your forgiveness application. So if you've reduced comp, of course, there's no way to get those numbers back up. Excuse me. Now, the other practical complication to applying for forgiveness early is the fact that while the SBA has started reviewing applications, they started looking at them on August 10th. Many lenders are not accepting them yet. The reason for that, for the most part, is because of this uncertainty around how this is all working, and a lot of lenders have themselves submitted questions to the SBA trying to get clarification on how things work. And so some lenders have. You just need to talk to your lender individually and see if they're accepting them at this point. I've heard some of the major lenders were targeting early September, so it should be soon. And I'd hope that everybody would be up and running in the relatively near future. That's not to say that you shouldn't start working on your application now, particularly if you've used all the funds for permitted purposes. It does take some time to pull together the materials. So there's really no reason not to, at least, and hopefully you've been doing that throughout the course of your loan. But certainly the SBA's application is available to take a look at. It's called a Form 3508. You can look at it online, and you should be able to work with your lender too. Hopefully, even though the lenders aren't accepting, a lot of them aren't accepting applications right now, hopefully they'll be willing to work with you at least to pull the materials together, answer questions you have, just to get ready to submit as soon as you're able. Now, practically, the way it's working is you'll see the Form 3508. Your lender will more than likely ask you to submit the application and supporting documentation through a portal that they're putting together. All the lenders are kind of using the same framework for the applications, but they're all doing it a little bit differently. They all, have their own portals, own websites that they're putting together. So throughout this entire process, it's very important to work as closely with your lender as you possibly can. That's not only true for process, but also for substance. If you have questions about things that are included, just how the calculation is going to work, the true authority on that from your perspective should be the lender. Now, they might defer and say, I need to talk to SBA, that type of thing. But for purposes of your, who you should take guidance from, that should be your SBA lender. And then in terms of, how long into the future do we have? It's 10 months after the end of your applicable covered period. So you have time. I mean, for people, people using an 8-week covered period, you might, your timing is a little shorter, still a generous amount of time. But for people using a 24-week covered period, it's unlikely that the covered period has even run at this point. Actually, probably impossible. And so, you've got plenty of time. There's no rush other than than wanting to get that forgiveness. Once the application is on file, the lender will have 60 days to look at it, review it. Once the lender approves it, it needs to go to the SBA. The SBA has 90 days to review the application and remit funds to the lender, at which point your loan will be forgiven. As Bria discussed, loans in excess of $2 million, the SBA has said they're drawing a point of distinction amongst loans that are above $2 million. It's reasonable to believe that loans of that size, it'll take the SBA a little bit longer to approve the application and remit the funds, just given what they've said about reviews. But in all cases, it's not a quick process between the lender's time and the SBA's time. It could be as long as 6 months before you know if you're getting forgiveness. Subsequent to that, there's an appeal process. If the lender denies the application, you can go straight to the SBA. You would have 30 days to seek SBA review of the denial. And then even within the SBA, if SBA denies, then there's an additional 30-day period to seek an appeal from the SBA Office of Hearings and Appeals. So you'll have a couple bites at the apple if you disagree with any decision along the chain. I believe that was it for my prepared remarks. I'm just double checking my notes. There were a couple questions that we received, particularly on forgiveness process and how it works. I think I'll go through those very quickly here, to the extent I haven't already addressed them. We got a question on the form EZ. So there's the form 3508 and 3508 EZ. EZ just means you're not going to, if you don't have any employees, say you're an independent contractor or you're a business with no employees, you can use EZ. You can also use EZ if you don't have any reductions to your forgiveness amount. So if you have not let anybody go and if you have not reduced comp, there's worksheets that are attached to the bigger form that address comp and headcount reductions. And so if you don't have to fill those worksheets out, you can use the EZ form. A question, if you applied for a loan through a certain bank, do you need to go through that same bank for forgiveness? Unfortunately, you do. And that question has come up when, you have a lender who hasn't started accepting applications yet, people wondering if they can go somewhere else. But unfortunately, you need to wait for your lender to be ready. A question about whether can the owner of a company pay himself a bonus and use a portion of the PPP funds to do that. The answer is to the extent a company gets a PPP loan, they can only use that to pay their employees. So if the owner is an employee, a W-2 employee, that's technically okay. Except that I would caveat that, first of all, there's this $100,000 limit that applies to everybody. You can't use funds to pay somebody in excess of $100,000 a year. Caveat, to the extent the owner is employee, as everybody has seen, even the press is very focused on who's receiving these funds, who's using them. Even though technically something like that would be permitted under the letter of the rules, you always need to kind of keep in mind, how does this look just from a press perspective or from honestly, just kind of a fairness perspective. So setting aside all the complex rules, there's always that overlay as well. And I think we had some questions that we're not going to have time to answer. I see we're pretty much out of time here, but we're gonna endeavor to take those offline and try to answer them and get back to people separately.
Yeah, Lance, that was great. And in fact, yeah, we see questions, and in fact, are coming in pretty, a lot of questions are coming in. So yeah, I think it makes sense, Lance, what you say. We'll pause here and then we'll follow up offline. That makes a lot of sense. And so thanks very much for running through all that. And I think with that, Christine, I think on our end, we're set. And thanks again very much for having us. And I will turn it back to you, Christine.
Great, thank you, Cliff, and thank you each of our panelists for being with us today. I know your expertise on this subject matter is very much appreciated by all of our attendees and us here at FSI, so thank you again for your valued partnership. If we didn't get to your questions, we'll be sure to follow up with you. I also want to take this opportunity to remind you that we have our next Ask the Experts webinar, part of our diversity and inclusion series, happening this Wednesday, September 2nd at 3 p.m. Eastern. This is a free webinar for all of our FSI members, so please register at financialservices.org/events. Slides will be sent in a follow-up email, and an on-demand copy of this presentation can be found in our webinar library, located under the Events tab of our website. And finally, if you could take a few minutes to fill out our short 4-question survey that will appear following the webinar to offer your feedback. Thank you and have a great day.